Welcome to Wealth Builders with your host, Anthony Congemi, brought to you by Crescent City Retirement Group, the show that's all about helping you grow, protect, and secure your financial future. From Social Security maximization and strategic 401k and IRA planning to tips on life insurance, Medicare, and annuities, Anthony and the team at Crescent City Retirement Group have the tools you need to help set you up for a successful retirement. It's time to take control of your financial future. Now here's your host, the trusted voice in retirement planning, Anthony Congemi.
All right, welcome to another show of Wealth Builders. My name's Anthony Congemi, and we have I think a great show for you this morning. We are looking forward to getting into this material, but before we do, I'd like to introduce our fabulous co-host that we've had for many, many years. We really couldn't do the show without Tony. So Tony, thank you so much for joining us as you do every Sunday morning. Thank you for being here.
Oh, well, I'm so happy to be here. I'm really excited. I'm glad. I'm trying to think of all the expletives I could use because, I love talking to you. We always talk a bit before the show and after the show, and we have so much fun hanging out each week. This isn't work, right?
Absolutely not.
Giving advice, and you love helping people, and you're an educator, right? And that's what Wealth Builders, the show, is all about. And so now we're on YouTube, we're on radio, we're on all the podcast sites, getting the message out. And I'm just excited about that for today's show. I do have to say, though, really quick, before we jump into how to deal with all this volatility, the tariffs, the volatility, and the 5 pillars to deal with that. That's what you're going to talk to our listeners about today. But as far as my week, I've had a much better week than the markets have had. Here's why. On Thursday of last week, I went and saw Bill Murray, yes, the actor, comedian Bill Murray, live with a blues band. It's Bill Murray and the Blood Brothers. He's touring and singing.
Oh, wow.
With this blues band called Bill Murray and the Blood Brothers. And it's him. I mean, it's crazy.
It's Bill Murray.
Yeah, I had 6 row dead center. We were 6 rows back. I took my son for his 26th birthday. And it was
he's
great.
Singing blues, Tony? He's
singing rock and blues. Yeah.
Okay.
Yeah.
And he was good, huh?
Yeah, he's pretty good. I mean, the first couple songs, there are some rough points. He's not like a pro singer, but man, the last 3 tracks, he was just really getting into it, nailed it. And, some of his movements and interactions with the band were funny. My only disappointment was he didn't talk that much. I thought, maybe he'd tell more stories. He did get up there and talk about the venue and the city and what he likes and doesn't like and his history with that. And it was really neat. And they had a comedy / musician open up, Dave Hill, who was very funny. So it was an enjoyable evening all the way around. So that was my last week. And then this weekend, we had beautiful weather here. How about there? How have you been?
Been good, Tony. Yeah, that sounds neat. I saw Bill Murray not that long ago on I don't know what it was. It was a clip, and he was always so funny, huh? With Saturday Night Live. I guess they all started there, huh?
Yep.
I think of Chris Farley and
Chevy Chase, Bill Murray,
Chase,
Dan Aykroyd, all those guys.
Guys, yeah. Who's the other fellow with the white hair?
Steve Martin.
Steve Martin, yeah.
Yep.
So, but well, that's great, man. That's good. And didn't do any stand-up, though. No comedy, huh? He didn't really do any.
He was funny a few times, but it was a concert. Isn't that odd? I mean, to see, and I'm like, I looked over at my son Adam and I go, here's a guy who's making $20-30 million a movie, and he's touring clubs and theaters. We saw him at a beautiful, renovated old theater, the Orpheum in downtown Minneapolis.
Okay.
It holds, I don't know, 1,200, 1,500 people at least.
Yeah.
And it was packed.
Yeah.
It was amazing. So that was kind of fun, but yeah, it is fun and all those comedians, but I thought he would maybe do some stand-up or at least tell some stories. That was interesting. But it's billed as Bill Murray and the Blood Brothers, and he's up there singing, wailing, kind of like the Blues Brothers thing that Aykroyd and Belushi did.
Yeah.
Yeah.
Which I love, man. I tell
Oh,
you that,
man. Yeah,
that's some
I
good
love them.
stuff, man. But yeah, we're gonna still have, we've got we've got some good blues down here, and so
Oh, well, you can't beat the music in New Orleans can't be beat. In fact, they did I can't remember the artist. It was a New Orleans artist. They did a cover, and I can't
and
remember.
incidentally, Tony, that's New Orleans.
Nolans.
In New
Nolans.
Orleans, but yeah, that's right. New
Nolans.
Orleans, yes, sir. You got it.
New
But yeah, we'll
Orleans.
get you down here a little bit, and then the slang will start wearing
I
off
know.
on you.
I had it down. I shouldn't. Yeah, New Orleans. That's not it. Nolans. Yeah. Yeah, I got it.
good though, man.
But yeah, they did. I think Louis Armstrong, or I forget what they were doing, but they were doing some good Nolans artists. That
Artists,
was
yeah.
They did some blues and Zydeco and stuff, all that stuff. It was great. So,
Mhm.
but man, that's what I love about New Orleans.
Coming down here, huh?
Yep, that's
Yeah.
what I love about it is the music. It's so great.
Yes, sir.
Best
Well, very
music in the
good, Tony.
country.
Yeah, and so our weekend was good, and so far last week was great. We just been helping our clients. Of course, we're leading into the final phase of tax season here, and so all of that's going well, and helping our clients. One of the things that we like to do is really take a close look at all the 1099s that come through. I'd say just a side note for our listeners, do yourself a favor, and when these tax reports come in and these 1099s, just verify that the numbers look correct. There's sometimes, there's mistakes that are made even on that level, and having another set of eyes to check those 1099s, especially the ones that refer to cost basis. For instance, if you have an IRA, Tony, or some type of retirement account, and you're taking out, let's say, $500 a month out of that particular account, well, then you'd expect that the total distribution was $6,000 for that year, and you can verify on the 1099, yeah, that's how much it says, and what the taxes were that were withheld, right? So those are good to look at. And then the ones with the after-tax funds, where I saw one the other day. It was a custodian that we've frankly worked with in the past, and many people have. I won't mention any names, but the 1099 wasn't correct. I mean, but it was an obvious mistake.
Sure.
And so I guess what I'm saying is it's always good. And then even for your tax prepare, because I know in some cases when people just go to these certain tax preparation services, they just a lot of times they're just plugging in the numbers, and just taking a minute, just be aware of taking the minute and making sure that the 1099s look correct, because every now and then you will find some mistakes. And unfortunately, I've found that if mistakes are made in the government, in the IRS favor, there's not, a lot of times it just goes unanswered, and people can pay more than they needed to pay.
Sure.
So
Sure.
checking those 1099s are a good idea, but we've been doing a lot of that, just making sure that our clients are prepared to finish up their tax return, and all that's been done. And so it's been a little hectic at this time, but like you say, Tony, we just love dealing with our clients and working with our clients, and just being a good resource and a good advocate for our clients. I mean, is really the objectives.
Yeah. Yeah. Well, and you are, and I know you work really hard. Now, lately, we've been dealing with this market volatility. And I mean, everyone out there listening probably has heard too much or a lot about tariffs and how they've affected the markets. And we've seen a lot of decline in the markets, a correction headed near bear territory, then some brief upswings and down again. It just depends on, if somebody in China sneezes, or if the president posts on social media, the market goes one way or the other. And so we're seeing a lot of ups and downs, but I know that you really help your clients put a plan in place to deal with that volatility so they don't need to worry about it. Is that correct?
Yeah, absolutely, Tony. So when we think about income planning and retirement, we're looking for let's say the majority of that income, let's call it 75 to 80% of the retirement income to be structured income, i.e., Social Security, pensions, annuities, interest, bond ladders, that sort of thing. So I guess what I'm saying is there are ups and downs in the stock market, but I think, the kind of the short answer is your retirement income, or at least a pretty good percentage, let's call it 75 was what we shoot for, 75 to 80% of the retirement income should be coming from structured income sources like Social Security, defined benefit plans, pensions, annuities, bond ladders, things that are structured income. If too much, just think about it like this. If, let's say, it was reverse, right? Let's say 80% of your income in retirement was coming from the stock market, right?
Right.
Then that volatility could really affect your retirement income plan,
Right.
because we all know that the worst time to draw money out of an account is when it's going down, right, in the market. So having that appropriate balance and really understanding the income sources versus, let's say, growth portfolios that are going to be subject to market volatility, just having that appropriate balance is a big, might sound overly simplistic, but I tell you, it's the difference, Tony, between being in the, let's say, the accumulation phase. You're working, you're saving, you're working, you're saving, like you and I right now. We're
Right.
working and
Right.
we're saving. So even though, Tony, when you log on to your 401k, let's say, and it's down, you're not pulling money out of it, are you? You're putting money into it,
So it's
right?
actually, corrections are a good thing to people who are still working, still putting money in. At least if you're 3 years or more out from retirement, there's no reason to panic at all when the market has a downturn or even a bear market, because
You're
you're
buying
putting money
shares
in.
at a better price.
Every paycheck, money's going into your accounts,
Hmm.
hopefully, and
Yep.
hopefully a good amount. You should be putting as much in as you can to your retirement accounts, and then you're buying low, and that helps you in the long run. And you're taking advantage of those upswings then when it does go back up, because it does, and it always
Right.
sets record highs.
Right.
So you're going to make a lot of compounding interest on the way up, and year by year, year over year, aren't you?
Absolutely. And that's where the term dollar cost averaging came from. You're putting money in, like right now, you're putting money in. You may see your share prices down on the funds that you're in your 401k, but you can certainly chalk that up to, hey, we're buying shares at a better price. So I'm getting more shares for the amount of money that I'm putting in than
Right.
I was when the market was much higher. So, but you're in the accumulation phase, right? So just as we could say it's is good to be putting money into a portfolio when the share prices are down, right? Because you're buying at a better price. That's how bad it is to be taking money out when the share prices are down, right? So the difference between the accumulation phase and then let's call it the distribution phase.
Yeah.
When you're not putting money into your portfolio anymore, you're taking money out. And so that distribution strategy really needs to be, uh, you know, thought out. I mean, we need to have structured income in retirement. And let me just go on to say that even the portfolios that you're in retirement, the portfolios that are going to be structuring income, let's say for the first 5 years of retirement, can be invested differently than a portfolio that's on the second leg, let's say 5 to 10 years of retirement, because you have that more time horizon for that money. So does that make sense? In other
Yeah.
words, where your investments and the portfolios themselves have to align with the overall distribution strategy. So it's the portfolios and the investments that are supporting the plan. So you need to have a plan, right? A retirement plan, a distribution strategy, and then the investments themselves have to support that plan.
Yeah.
Okay. And so, but getting back to it, I would say that fair trade, obviously, I think this trade deficit that our country's been holding, and the amount of jobs and the amount, the companies that have left our country. And I think what our current administration is trying to do is obviously get some a little more fair, balanced trade, obvious trade policies.
Level that trade playing field, right?
Yes, sir. Level the trade playing field. Now, how we go about doing that, and the
that's
approach.
Up for debate. We don't want to get into the politics of it. But there are pros and cons, and a lot of people have problems with the way he's been going about it.
Right.
And maybe it was too much too soon, and that caused some of the volatility. And I think people even, what on both sides have been pushing him to maybe step back a little bit or make some exceptions, which he has. And so we'll see where it goes. But it does cause volatility. Like I said, somebody could sneeze in China and there's volatility. Right. But that's what I love about what you do for your clients and can do for our listeners. And we're going to talk about this today some more, is those 5 pillars that they can use to make sure that the volatility doesn't derail their retirement plans and their savings, right?
Absolutely, Tony. And think about it like this. Would you, if you retire at, let's say 65,
sure,
and your retirement plan is going to run to your age of 100. Let's say that's the parameters there in the time horizon.
Mm-hmm.
I mean, would anybody think that over a 35-year time horizon, from the time you retired 65 to 100, is the stock market going to go straight up over that 35-year period? And I think most people would say, no, that's not likely. And then it was, well, all right, will it go straight down over the next 35 years? And that's not likely either. We know that over this time horizon, there are going to be some ups and downs in the stock market when we retire. Right. I mean, there's a long, if you're planning a 30 or 35-year retirement, you've got to figure there's going to be some real good years. Right. Yep. And we're going to be, high-fiving each other. Yep. And there's going to be some years that don't look so good. Right. So if we already know that to be a reality going into retirement, then why wouldn't we just have a strategy in place that understands that there is going to be volatility and that we've already made the allowances to accommodate those volatilities when, not if, but when they surface? So why should it be? Now, I get the fact that, for our economists out there that may have a different approach to trade and different approach to tariffs and just fundamentally. But when we bring it all down to the here and now and what we can really do in our own economy, right, our own financials, I would say those 5 pillars are the keys really to a more secure retirement. And so what are these 5 pillars? And they're just simply, and we've talked about it many times over the show, estate and legacy planning. We have to have a plan in place in case we pass away. We want to make sure our spouse, kids, grandkids are taken care of. We need to have a good investment strategy that accompanies an income plan. So as we just said a minute ago, if you're going to have a structured income plan in retirement, we have to have an income plan that, let's call it 75 to 80% of that income is really structured income. It's not subject to market volatility. So you need a structured income plan, and you need to have an investment strategy that supports the income plan. So we have estate and legacy planning. We have an investment strategy, income planning, and then, of course, healthcare is going to be real important, and taxes. And we consider those 5 key pillars really the fundamentals to any sound retirement plan. And if you've got them in place, then the whims of the market or the ups and downs, and like you say, somebody sneezes and all of a sudden the market tanks. Yep. Well, my goodness, if all our hope and our strategy is, let's just make sure the world's going to be a peaceful place for the next 30 years, and there's never going to be any disagreements or policy changes, and if we're dependent on nothing but rainbow and roses for the next 30 years in the world economy, well, obviously that's probably not the case, right? So we need to be able to do some things on the home front to be able to weather those volatile times, and that's going to come from a good old-fashioned retirement plan that understands the 5 key principles, which is estate and legacy planning, investments, income, healthcare, and taxes are really the key elements.
Well, right. Yeah. And so those are the pillars, and you talk about the 5 pillars, right?
Yes.
Yeah. And so really that's a part of a plan. And so for our listeners and viewers out there, Anthony, to get a plan in place or maybe get a second opinion, if you feel you've already got a plan in place, have you gotten a second opinion? How often are you talking to a trusted financial professional who's a fiduciary, who's looking out for your best interest? Pick up the phone and give the team there a call. I know that you'd love to hear from our listeners and viewers out there. Oh, real quick, what's that phone number?
Absolutely. So it's 504-828-2171. Again, area code 504-828-2171. If you have a plan or you'd like to get a second opinion, if you'd like to vitalize the plan that you have, and you'd really like to see what we offer here at Crescent City Retirement Group as it relates to retirement planning, you can visit us online at crescentcityretirement.com. Or as I say, just simply call the office, 504-828-2171. And let's go about the business of looking at your retirement plan and seeing if there's any areas that can be improved upon.
Yeah. Yeah. And that's so important, Anthony. And I know last week we talked about taxes, which is one of the pillars. You have to have a good tax plan in place to minimize that burden. And we had one of the CPAs that you work with to help your clients do that, and not just looking at this year's taxes or looking back or next year's taxes, but looking ahead to taxes in retirement. That's a big one. But when it comes to market volatility, I think the biggest one is asset allocation and risk tolerance, right? And those are part of the 5 pillars, correct?
Absolutely. And so again, and time horizon is real important. So you can have a portfolio that you are going to be generating income from. Well, the question is, how much income does that portfolio need to generate, and when does it need to generate it? So, when you have portfolios in the market, just because you're in the stock market doesn't mean all of these portfolios are doing the same thing. Some of them are very conservative. They don't have a lot of volatility, and they're more income producing assets. Some of them are much more growth oriented and much more volatile and don't really produce a whole lot of income, but they're more growth oriented. So pairing the appropriate investments and portfolios and asset allocation to the retirement plan itself to make sure that we are invested appropriately based on how we're using that model, that portfolio, is really the key, Tony. Let me give you a real quick example of what I'm talking about. Let's say you have a purchase where in the next 90 days, you're going to be purchasing an automobile and you need to allocate $50,000 for that car. So you know exactly what you're going to need, and within the next 90 days, you need to have that money available. So would it be appropriate to have that money invested in a high growth, portfolio that potentially could make a lot of money, but could also lose a lot of money, and you only have 90 days before you're going to need that money? Well, obviously not. Maybe a 90-day CD, maybe something very conservative where you can earn some interest, but the maturity date lines up with the distribution you're going to need to make. So working with a firm, a retirement planning firm that can help with those uncharted waters that you're maybe not as familiar with because you haven't been there, right? Is just like a guide, Tony, somebody to help guide you through and have a plan in place that's going to be that's going to, satisfy not only your needs and your income needs, but also for generations to come.
Yeah.
You just have to make sure. And let me just say, and not to be overly redundant, but taxes, and we've talked about taxes this whole month, taxes really permeate all aspects of a retirement plan, whether it be estate planning that we're
Sure.
talking about, income, investments, healthcare. Taxes are really a fundamental aspect of it all that has to be considered.
Yep.
And I would just, encourage our listeners, if you're listening and you don't have a formal retirement plan, pick up the phone and call our office, 504-828-2171, or visit us online at crescentcityretirement.com and let us help you put something together.
All right. Well, great show today, Anthony. We covered a lot of ground. You gave us a lot to think about and chew on. I really hope our listeners will pick up the phone, give you a call. And listeners and viewers, that does it for today's episode of Wealth Builders with our host, Anthony Kinjemi.
Thank you for listening to Wealth Builders. Don't pay too much for taxes or retire without a sound income plan. For more information, please contact Anthony Kinjemi at Crescent City Retirement Group by calling 504-828-2171 or visiting them online at crescentcityretirement.com.
Fee-based financial planning and investment advisory services are offered by Crescent City Retirement Group, LLC, a registered investment advisor in the state of Louisiana. Insurance products and services are offered through Crescent City Insurance Group, LLC. Crescent City Retirement Group, LLC, and Crescent City Insurance Group, LLC are affiliated companies. All matters discussed during this show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.